All right, so one thing we could do is finish the due diligence for farming. We're going to do more requests than ever before. Celsius is requested. Josh Kitty now. Yeah, we could do a little Carvana. Fuck it, let's start with Celsius. Wow, Celsius has dropped a lot since we last looked at it. It's around a 5.2 billion market cap right now. Let me put it somewhere here on the bottom. Or on the top, I don't know. We probably have to look at Monster if we want to look at Celsius. Yeah, so 5.3 billion market cap. That's because there's $22 a share. There are 235 million shares. That's a lot of shares, right? Each one's $22. So if you wanted to, I don't know, own 10% of the company, you would have to spend, you'd have to buy 23.5 million shares. Does that make sense? Because there's 235. 23.5 million shares. Even if they were $1 each, that's 23.5 million, but they're not $1 each, they're $22 each. So that's 530 million, and you would own 10% of the company. And then, you know, if you own 10% of the company, you're probably the largest shareholder. You get to call some of the shots. You have some say, but you still don't own that much. What's interesting is I haven't heard of any of these other drinks. Most of these other drinks, I should say. Of course, I drank Red Bull myself. Monster, I know because it was one of the hottest stocks in the world. Celsius, we drink sometimes at work. C4, I never heard of. Rockstar, I've heard of it, but mostly like in social media and stuff like that. Then you've got the next five I've never heard of. Ghost, Alani, Rain, Nos I might have heard of. And then Bang, never heard of any of these. And that's not Rockstar, the Take-Two brand. Shush now, kitty. Shush. I don't care what you think and what you say. You're just a cat. Okay, so how'd they do in Q3 and how are they going to do in Q4? I want to show you guys this concept of alternative data, really important. And it shows you what you're up against when you trade. Oh, they had a monster. Did they have monster? No, they had a terrible Q3. Got it. They had a worse Q3 than even I thought they would have. So instead of doing 280, they did, instead of doing 320, they did 265. Oof. And I know there was some Pepsi, you know, some weird Pepsi arrangement, stocking or something. I don't know what it was. But revenue was down 31%, which, you know, probably freaked investors out. As it would freak anybody out, I would think. Okay, so yeah, the question becomes what'll sort of happen. Here's the press release for the quarter. I don't know what their guidance or whatever it is that they give. Do they give guidance? Hard to say, I'm not sure. Doesn't look like it. It's not really that much work, Umar. Yeah, I like PayPal. Yeah, so I'm not really sure they give forward-looking guidance, which makes it, maybe they give it on the call. I don't know. So there's something called, there's a couple of these things. One is called YIPIT data. And so YIPIT data, what Wall Street funds do is they buy this data, which is credit card data. And they know day to day, every single day, what the sales are for Celsius from those credit cards. Now, the credit cards aren't everything, but they tell you a little bit of the story. So when somebody buys a Celsius from CVS or from Dwayne Reed or whatever, they are, getting that kind of data and trying to figure it out. Another one is Seven Park. There it is. I guess they probably got bought out. Yep. Looks like they got bought out. We hired somebody from this firm. I don't know if they still have a website. Looks not promising. So anyway, there's I think they're mostly looking for enterprise contracts. I mean, so we're going to basically add this to Godel, and that's going to be the way that you can buy it without being a big firm. So stay tuned for that. Credit card data, so you can see throughout the quarter whether the company's going to meet their guidance or meet their earnings or something like that. So there's a couple of these players, and we'll be able to get that data. Okay. So let's listen to the call. Shut up. Hold on. I recognize that last name. One second.
And in our quarterly for additional information.
Sorry. My bad.
And adjusted EBITDA margin and their GAAP reconciliation. Increased 7.1% year over year on unit sales increase of 7.3%. Celsius resilient growth at retail overcame softness in the category, which grew at 2% in the same period. Once again, Celsius was a significant driver of the overall energy category, contributing more than 16% of all growth. Total revenue for the third quarter was $265.7 million, a decrease from last year, primarily attributed to distributor inventory optimization, which Jared will discuss in greater detail on this call. Year-to-date, revenue through September 30th was $1.02 billion, an increase of 5% from last year.
It's a treacherous industry,
data
so
we are seeing continues to be supportive of us being the largest driver of the energy category. I want to reiterate our three key growth drivers that we are focused on for the rest of the year and beyond. Attracting new consumers into the energy category, expanding a product availability, and increasing consumption frequency. We believe that we're making progress across each of these initiatives will help us pursue our vision of becoming the leading energy drink brand. Let me share more details on how we're thinking about each. First, we are continuing to bring new consumers into the energy drink category through premium marketing and innovation around better for you, great tasting energy. Celsius continues to deliver innovative flavors that resonate with consumers, such as our new on-the-go powders in our Vibe line, and RTDs like sparkling watermelon, lemonade, and cherry cola, which we're taking nationwide due to strong consumer demand. Two recently announced Celsius essential flavors, Grape Slush and Watermelon Ice, alongside our new 2025 Vibe and Core line innovation previewed at the convenience store trade show NACS, keeping consumer excitement and category trial high. We believe that Celsius continues to outperform on taste, function, and our brand association with the Live Fit lifestyle that brings new consumers into the energy drink category through our marketing. Second, in terms of expanding product availability, based on recent industry surveys, we expect energy will continue to gain shelf space in the beverage coolers and aisles, with Celsius being a strong beneficiary of these gains. This validates positive customer conversations we had last month at NACS. Domestically, Celsius market share has been resilient with our share in MULO Plus with convenience in the last 4 weeks ending October 6th, rising to 11.6%, an increase of 10 basis points from this time last year. We are focused on re-accelerating our share growth. We believe that our incentive program with Pepsi, featuring priority periods and aligned resources, should provide additional tailwinds for us going forward. Turning to other channels
Monday, $16
that are
billion
expanding our
company,
availability, approximately 12.3% of Celsius total North America sales to PepsiCo in the quarter was to the food service channel, with strong results in workplace, restaurant, recreational, lodging, and gaming sales. Lodging and restaurant points of distribution were up 46% and 27% respectively compared to last year. Celsius sales to Amazon increased 21% year over year to $27 million, up from $22.2 million in the prior year period. Celsius ended Q3 with a 20.4% share on Amazon, according to Stackline last 14-week read ending October 5th, 2024. E-com continues to be a great opportunity for us, building brand awareness and making our product accessible to consumers whenever and wherever they want it. Sales to Costco in the third quarter of 2024 increased 15%. However, sales to Sam's Club, BJ's were negatively affected due to timing of promotions and innovation load-in in the year-ago period. The total club channel sales decreased 4% to $60.5 million in the third quarter 2024 from $63.2 million for the prior year period. Our expansion is broader than just North America. In October, we launched in Australia and New Zealand. Our third growth driver is increasing consumption frequency. Celsius expanded energy drink consumption occasions with refreshing flavors and our aspirational Live Fit lifestyle. Celsius continues to grow our presence in incremental consumption occasions like mealtime through our partnerships with leading convenience stores and quick-serve restaurants like Jersey Mike's. We're supporting our growth drivers by investing behind the brand, but also in our organizational excellence, scaling operations, advancing technology, and developing our people. Last week, we acquired Big Beverage, a long-term Celsius co-packer, which is intended to give us new innovation capabilities, greater control of our supply chain, in addition to financial benefits that we believe will be achieved in the near and long term. We believe that vertical integration, like this co-packer acquisition, is a capital-efficient growth driver and another way we are investing in our long-term vision to become the leading energy drink brand in the United States. We've also recently established a new center of excellence in Ireland, intended to drive our innovation, global procurement, supply chain, and global marketing forward as we expand further across the U.S. and into new global markets. Our field sales, key accounts team have begun using AI-assisted selling tools, as well as a new mobile technology that optimizes vehicle routes for further efficient selling and relationship management.
Quantum computing, I think.
We are also investing in new technologies to improve efficiencies in our orbit model and reduce our freight lane costs.
Traveling salesman.
Importantly, we welcome two new additions to our already strong board of directors, Hans Mellep and Israel Konarvalski. These professionals bring extended global experience in consumer goods from their prior and present leadership roles at Starbucks, Johnson & Johnson, and PepsiCo. Israel replaces Jim Lee, who departed our board in conjunction with his move from Pepsi to Target. We thank Jim for his service, and we wish him best of luck in his new CFO role. Our customers continue to believe, as we do, that Celsius is a winning brand with a long growth pathway ahead of us. We are investing for long-term sustainable growth with strategies that energize our customers in more places more often. These three growth drivers are underpinned by our focus on organizational excellence across people, technology, and scale. With that, I'll turn the call over to our Chief Financial Officer, Jerry Langens, to discuss our third quarter results. Jerry?
Thank you, John. While the third quarter was anything but normal, Celsius generated positive net income despite a significant revenue headwind, demonstrating the strength of our financial position and operations. Moreover, we continued to invest in our brand as we stayed focused on driving our sales and marketing efforts, and we put a portion of our cash on hand toward vertical integration with the acquisition of Big Beverages. All of this to invest in our long-term growth. This quarter, revenue was approximately $266 million, down 31% from $385 million in Q3 last year, primarily due to inventory optimization by our largest distributor, impacting revenue by around $124 million. Promotional allowances from increased retail sales created revenue headwinds due to the imbalance that existed between the decreased sell-in to our distributor and increased sell-through at retail. Additionally, the previously announced incentive program with our largest distributor and its network of franchisees fully ramped up in the third quarter. This program further aligns our financial incentives through priority periods and other measures, but does impact our margin.
Well, they said that it impacted by 124 million, right? Did you guys hear that? So I just added that back.
Sales created revenue headwinds due to the imbalance that existed between the decreased sell-in to our distributor and increased sell-through at retail. Additionally, the previously announced incentive program with our largest distributor and its network of franchisees fully ramped up in the third quarter. This program further aligns our financial incentives through priority periods and other measures, but does impact our margin. Revenue was further impacted by reduced unit velocity and softer macroeconomic conditions. North American revenue for the 3 months ended $6 million, down 31% from $385 million in Q3 last year, primarily due to inventory optimization by our largest distributor, impacting revenue by around $124 million. Promotional.
Okay, I just want to make sure I got that number right. So 124 million. All we have to do is add that back, right? So it was 266, which is atrocious because last year was 385. And if you're a growth company, revenue's supposed to be going up, not down. So we take that 120, what was it, 124, 129? I think they said 129. And we put that back in, I think it was 124. And growth would have only been plus 1%, which would still freak me out. So 1.5 billion. It's trading like a no-growth company, though. So they're complaining about all kinds of other stuff, that there are all kinds of other problems with inventory and things like that. Well, who's saying more people are trying it? Yeah, usually you only have inventory problems if you're not selling through, right? You ship too much inventory and you don't sell through enough, you have to wait before you ship again. So it's not a good problem either way. Yikes. So what would you pay for a no-grower? I mean, you'd pay something, right? It's kind of trading like it's a no-grower. No, not Celsius from crypto. That's Mashinsky.
Allowances from increased retail sales created revenue headwinds due to the imbalance that existed between the decreased sell-in to our distributor and increased sell-through at retail. Additionally, the previously announced incentive program with our largest distributor and its network of franchisees fully ramped up in the third quarter. This program further aligns our financial incentives through priority periods and other measures, but does impact our margin. Revenue was further impacted by reduced unit velocity and softer macroeconomic conditions. North American revenue for the 3 months ended September 30th, 2024 was approximately $247 million, a decrease of 33% from $371 million in the prior year period, primarily driven by the previously mentioned inventory optimization. International revenue grew 37% to $18.6 million in Q3 2024 compared to the same period last year. Year-to-date total revenue through September 30th, 2024 was approximately $1.02 billion, an increase of 5% from the prior year period. Gross profit in the third quarter decreased 37% to $122 million, down from $194 million in the prior year period. Gross profit margins in the third quarter were 46% of revenues compared to 50.4% for the prior year period. These effects are due to the aforementioned inventory optimization and full implementation of our incentive program in the quarter with our largest distributor. However, margin pressures from these two factors were partially offset by reduced outbound freight costs and savings on the purchase of materials. Year-to-date gross profit through September 30th, 2024 was more indicative of our full year operations and was $513.5 million or 50.2% of revenue, an increase of 10% compared to $466.9 million, or 48.1% in the prior year period. Sales and marketing expenses as a percentage of revenue for the third quarter were 37.6% and 26.1% year to date. While the sales and marketing expenditures were in line with our forecasted expectations, they were much higher as a percentage of revenue due to the optimization that took place by our largest distributor, which resulted in approximately $124 million less in sales. With that said, we continue to invest and support our brand in a thoughtful manner without creating disruption to our ongoing campaigns and investments. Q3 2024 general administrative expenses rose 11% to $25.5 million, representing 10% of sales, up from 6% last year. Year to date through Q3, G&A expenses were 7% of total revenue, in line with expectations. Non-GAAP adjusted EBITDA for Q3 decreased 96% to approximately $4.4 million from $103.6 million last year, with the year-to-date adjusted EBITDA margin of 18.8%, totaling $192.8 million. Q3 net income decreased 92% to approximately $6.4 million, down from $83.9 million last year, with year-to-date net income of $164 million. Despite the quarter's pressures, we maintain a cash balance above $900 million, and we are generating positive full-year operating cash flow. This concludes our prepared remarks. Operator, you may now open the lines for questions.
Yeah, I'm not surprised it's so
Thank you.
low.
The floor is now open for questions. If you have dialed in and would like to ask a question, simply press star 1 on your telephone keypad to raise your hand and join the queue. If you would like to withdraw your question, simply press star 1 again.
I wouldn't short it.
If you
It's
are
trading
called
at
upon to
3
ask
times
a question
sales,
and are listening via loudspeaker on your device, please pick up
which
your
is,
handset
you know,
and
for a
ensure that
beverage
your phone
company,
is not
kind
on mute when asking your question.
subdued.
We do request for today's session that you please limit yourselves to one question so we can try to
But if
accommodate
next
our
quarter
increased
doesn't
number
grow,
of covering
bro,
analysts. Your
it's
first
over.
question comes from the line of Jim Salera of Stephens. Your line is open.
Guys, good morning. Thanks
Jerome,
for
investment
taking our
bankers.
question. I wanted to maybe drill down on the cadence as we close out 2024 and move into 2025. Just with the combination of, you know, some of the increased promotional you guys have in the channel, the new flavor launches. Is it correct for us to assume that we should see the trends in the scan data have improved sequentially month on month as we move through 4Q and then go into 2025?
Order partially filled.
Yeah, thanks, Jim, for the question. You know, we do have a variety of promotional activities planned for Q4 as well. The category is highly promotional, as we know. There is a lot of new innovation that's coming out from a variety of other brands within the category. You know, we're watching velocity on a weekly, monthly, quarterly basis. We have a lot of great plans in place for the back half and heading into 2025. We're really focusing on our growth drivers of increasing new to category, expanding occasions with a usage occasion expanding, as well as increasing availability. So those are things we're monitoring. We have a lot of plans in place just coming up in the next few weeks. We have a big program with Jake Paul, Mike Tyson. We're a title sponsor, so we'll be able to get some further national reach across the country and impressions. And the teams are focused on driving to retail.
Okay, great. And then maybe if I could sneak in a quick follow-up. If we think about, you know, the pressure that the category has seen, obviously still one of the better categories across retail. Just any thoughts on what you would want to see out of the consumer that would kind of re-accelerate category growth and, you know, drive energy drink category growth as we go into next year?
Yeah, I think, you know, when you look at the third quarter that we're reporting on today, it was troubled with traffic. We saw a lot of our major retailers talk about reduced traffic and convenience. You know, we need traffic to come back. We need occasions to come back. You know, but the good news is when you look at the Celsius portfolio, you know, our better for you and this performance, energy, and fitness lifestyle is a broad position that has a lot of tailwind behind it. You know, the better for you is not slowing down. And I think what's really exciting for us as we sit here today is in the quarter, we saw for the first time about 50% of the category is greater than 50% of the category is now sugar-free. So the sugar-free movement, it continues to build steam. We have an amazing sugar-free portfolio. We need macroeconomic trends to improve. We expect that to improve. We saw some additional growth in the category over the last several weeks from the lows, and actually the negative growth we saw in the third quarter. So we feel with our function, our refreshing taste profile, and our fitness position, we're well positioned when the category gets back, which we're confident it will. As you said, the category has been a great growth driver in LRB, and we're going to increase availability as well, which we're really excited about.
Great, thanks, guys. I'll hop back in the queue.
Thank you, Jim.
Your next question comes from the line of Kaumil Gajrawala of Jefferies. Your line is open.
Hey guys, good morning. I guess a couple of things. The first is you were specific to mention in your prepared remarks that the new incentive structure with Pepsi and that you're positive about it. Can you give us maybe some more details on what's behind that and why that should drive category acceleration from where we are now?
Yeah, when you look at it, the program, the further alignment incentive program we implemented in 2004 is really further getting implemented into 2025 with additional focus and priority periods. We just finished NACS last month and coming off their annual operating plan meeting that was in Las Vegas that our leadership team, as well as a variety of other team members attended.
What's really interesting is if you think about Celsius as a macroeconomic indicator, are people spending money on these premium energy drinks? There's something to that. And they basically had a terrible quarter. So you get real-time economic information from companies like this, in my opinion. It is a little backwards looking, but it's interesting.
Placements and getting Celsius in the hands of more consumers and disrupting that path to purchase, which is so critical on building a brand and getting more trial.
Thank you. And I guess the second question is, are they done? Is inventories in the right place? Do we just move on with consumption from here? Presumably you've chatted with them and hope for no more surprises, but I think we'd all like to know if they're at the place they want to be.
Yeah, we're watching the correlation between sell-in and sell-out. I'll throw that over to Jared to provide some further color on that.
Yeah, so we've got a handful of weeks of visibility into the fourth quarter. We're definitely seeing a tighter correlation on a weekly basis between the inventory sell-in and depletions, from our largest distributors' warehouses into retail when comparing to Q3. It's not fully matched yet, so there is a slight disconnect from the sell-through versus the sell-in with retailers, but it's very slight at this point in time. At the current rate, we should see alignment of the sell-in and sell-through before Q4 ends, based on the trends we're seeing and the discussions we're having. So our teams are definitely working together diligently to minimize any potential impacts in Q4. With that said, we could see some pressure in the quarter. November and December will be key drivers in this process. So as things stand today, depending upon how we end the year, we could see an impact where we see some positive benefit or potentially all the way up to maybe 15 million of pressure. That's kind of our visibility into today. So that's kind of the range we can offer and what we're seeing from that perspective.
Okay, thank you. Did I hear that right? Another 15 million for Q? Is that what you just...
I said we could actually see anywhere from a bit of positive benefit from it all the way up to around 15 million of pressure, depending upon how we kind of finish off the year.
Yeah, we need to see how November and December turn out.
Okay, got it. Thank you, guys.
Your next question comes from the line of Mark Astrachan of Stifel. Your line is open.
Yeah, thanks. Morning, everybody. Just quickly following on that last comment. I guess the question. Obviously, that's the question that everybody keeps asking over and over again. But your range of potentially 15 million of headwinds to slightly positive. I assume if we're all sitting here trying to look at this from our desks, the best way to think about this would be whatever end demand per the scanner data would look like, right? So if your sales trends are growing somewhere around where they are now, low to mid single digits, how does that look from an inventory destocking or restocking perspective? I guess maybe something to benchmark it relative to current performance would be helpful. And then I've got a couple of other questions.
Yeah, it's a good perspective, Mark. So I'd say if we start to see things pick up, then we have a better opportunity to benefit from that perspective. If we see things kind of turn the other way, then I would expect a little bit more pressure. So kind of if we stay where we are, we're probably tracking to not have anything substantial. But you kind of a little better is a little better for us, a little worse is a little worse for us.
Yeah, that's helpful. And then on market share. So I think, John, you said resilience. I think that was the word you used in the prepared remarks. It is hanging in there, but I suppose if you think about the share, it's still down, I don't know, point and a half from peak in May. I guess the question is, where do you think that consumer has gone? And what do you think Celsius can do to regain that consumer?
Yeah, I think when you look at it since that peak of May, there's been a lot of challenges. We've expanded into the convenience channel. That was the biggest opportunity for us within shelf space gains. And we did see some challenges there with foot traffic. We know from some of the data that we're getting in from Circana, our shopper is potentially taking maybe that one less trip, that one less occasion. So we think there's a big opportunity to really target increased consumption and occasions and bring those consumers back as confidence returns, and the category gets back to growth rate. I'm bringing new consumers in and expanding that. We think we have a great portfolio, the better for you movements there, sugar-free's there. We've gotten there's been a lot of innovation that's come in from some of the largest players, that are expanded trial. Maybe that shopper purchased another product of one of the new flavors that came in on one of the other brands. But we feel confident in our portfolio. We feel confident in some of the new innovation that's coming out for 2025. Coming out of NACS, we talked to many of our customers, and there's a lot of excitement around the energy category, expanded additional shelf space, and we heard positive feedback from many retailers on resets for 2025. So we'll see how that ends up, but we feel confident we're going to further expand space and availability, and we got some great retailer marketing programs planned into 25 and further alignment that I was talking about answering the prior question with Pepsi. We're getting further alignment each and every week, every month. We're collaborating better each and every day. And, this is getting into the third year of the relationship, and we're really looking to leverage that.
Got it. And just to follow up on that, so your share, it sounds like you're saying, is weaker in C-stores than it would be in mass, Amazon, Costco. Is that the way you to think about it?
Yeah, and that's historically if you go back even historically as it's been, our share as a percentage has been better in food, drug, mass, and on Amazon. So that's the big opportunity, is to close the gap. We got good share in a variety of in a national retailer as well as regional players. We just need to close the gap. We need to get better placements. We need to disrupt that path to purchase. We need to continue to drive household penetration. And we feel that the consumer's there. We know the sugar-free consumer's there, the better-for-you consumer, the fitness lifestyle consumer, and we're well positioned to capture that when this category gets back to growth.
Great. Thank you.
Your next question comes from the line of Peter Grom of UBS. Your line is open.
Thanks, operator. Good morning, everyone. So I guess I wanted to ask about the inventory, but maybe just the assumption for a slight benefit versus the $15 million headwind. Is this something you plan to update us on as we move through the quarter, maybe similar to what we saw in 3Q? And then of that $15 million headwind, what's kind of underpinning that assumption? I guess I'm just trying to make sure we don't have a similar negative update, if you will, versus similar to what we had in September, where things came in far worse. And I guess just building on that, you mentioned better alignment several times throughout this call. But how would you compare your visibility today on the inventory dynamic versus maybe what we saw in the spring and the summer?
Yeah, I think we have good visibility, and we've been working closer and closer together. I think some of what got caught up in Q3 was some very good optimization that took place and some very efficient optimization. And I think our largest distributor actually commented on that on their call a couple weeks ago. So they did a great job with that. We kind of got caught up in that in Q3 and Q4. You know, we're kind of just looking at trends, and we're trying to build an analysis, kind of some pot. You know, if things got a little better, if things got a little worse, that's kind of the range we provided based on the trends and the data we're following. And so that's our best estimate for you guys from that perspective. In terms of Q4 versus Q3, you know, Q3 was really where the optimization took place. The Q4 is more a product of where does the category go, more so than I would say any kind of significant optimization.
Okay, so that's helpful, Jared. I guess, so if you were to, as we stand here today, is the best way to think about 4Q North America sales growth?
Okay, I think I got a good picture. I think it's, I lean slight positive. But of course, you know, I'd stay away from it. It seems like they are growing. This inventory disaster, these things do happen. It happens a lot in pharma. It happens a lot in every industry. And the underlying growth last quarter was pretty bad. But it's not that expensive as it is. So with some resumption of growth, I don't know. It's challenging. I'd probably stay away from it without more data. Again, this is where the alternative data really shines. Wow, look at that stock. It's gotten really beat up. Can you believe this thing was $100 a share? See, when people ride with growth stocks, they really ride with growth stocks. I don't think it's starting to get to a price where it's hard to say it's overvalued. And so if it dropped to like 15 or something, I'd probably buy it. But yeah, that's what, like, I agree with Acer. It's roughly right. Maybe slight upside, but that also is, it's upside if a lot of things go right. Well, Monster is public, so you know, we should look at Monster at some point. Yeah, so this is a $45 billion company in Monster, so, you know, we'll see how they're doing. Oatly. I always thought Oatly was a dog. I mean, it's kind of a bankrupt company almost. Yeah, it sounds like a really tough, crowded category. That's its best growth days are behind it. You know, energy drinks 20 years ago were like really wild idea. That worked really well, and now we're looking at a world that's a bit different. I'm actually going to make a quick Monster model just because I'm really curious about this company. I followed this company 15 or so years ago. I was long and obviously did amazing. Briefly had a guy looking at consumer stocks for me. It's a little early for Kanye. First, generate some profitable trades, then you can listen to some Kanye while you trade. Put on Kanye. So that's the problem with you Zoomers. You're too lazy. You want to listen to music while you work. but I need my music. I need to listen to music. The fuck out of here. You trying to get rich or are you trying to listen to music? I'm not listening to any fucking music while I work. Well, why would I listen to the earnings call when I can listen to Kendrick Lamar? He's got more information for my career.
Order filled.
Okay, so Monster isn't growing either, so that makes sense. So energy drinks are just a soft category. So the 1% growth, when you add back the Pepsi distributor problem, that's exactly the revenue growth for Monster. So it's really no lies detected. And if they're not gaining share, yeah, I don't know. It looks like it's fairly valued. It definitely doesn't look cheap. Yeah, I need to learn some Muay Thai. Morning, Rabbi. Good morning. Kanye had some crazy tirades over the weekend. I still... I think he's... yeah, I don't know what to say. There's a heart deep down in that guy. I saw the live gooning too. That was worrisome. Yeah, it's textbook. Yeah, I don't know. I don't know what to say. The guy's really got conviction in his beliefs. It's remarkable. All right, cash flow from... Oh, did he delete his X account? No, he didn't. He did? Oh, man. I got this text last night. 12:41. Call urgent from Kanye's camp. I missed the call. I was asleep. Yeah. I don't know. No, I just got up, so I texted back. I said, let me know when you're awake. What? There was a Super Bowl ad, too? Jesus Christ. Oh my God. $20. Yeah, I mean, I think the way he looks at it is performance art. Is he's basically trying to. There are artists who believe that, like, and I don't endorse this, by the way, but there was one person after 9/11, which, if you guys know me well, you know how much 9/11 impacted my life. There was somebody at the time of 9/11 who said that it was the greatest artwork ever done, the whole disaster. And, you know, it was really insulting at the time. But, you know, yeah, part of some artists want to do is shock people. I don't necessarily think Kanye. Sometimes he surprises me, but I don't know if he operates on that level of, like, I'm a modernist like Dali or something like that, or if he's, you know, just saying crazy things, or if he's saying crazy things and there is, like, a purpose behind it. So, for example, South Park said that there was an amount of time that it took to make fun of AIDS. And you remember the episode where Cartman was talking about being HIV positive for being sure about something. Oh, are you sure cassava's a short? I'm HIV positive. You know, there was a requisite amount of time that had to pass before something became funny. Now, tragedies like 9/11 are never funny, but kids still make fun of 9/11 now. I see it on TikTok and it disgusts me. It's become a meme. So yeah, I don't know what his story is. Yeah, there you go, Jensen. Something like that is right. I don't know. There is anti-Semitism in the black community. I mean, that is a real thing. When I was in jail, I saw quite a bit of it, and I tried to confront it head on. And I mean, I got through to a lot of people, you know, but most I think a lot of different cultures don't know each other and take stereotypes and use the stereotypes for replacement of everybody else. And Kanye says stereotypes are real. They're there for a reason. And it's not totally untrue, but Monster's expensive too. There weren't too many Jews in prison, but there were definitely some. And there were more people getting kosher meals than anything else. Kosher food was a little bit better, so a lot of people said that they were Jewish. We don't sell API yet. We may. We may someday. Okay, so Monster's pretty expensive too. Monster. I gotta look at the full year cash flow, but Monster doesn't exactly look cheap. If you know what I mean. Okay, they were growing quite quickly, quite rapidly, strongly, robustly. Okay, cash flow. Yeah. Ah. Okay. I don't know. Let me at least text and see. Yeah, Red Bull's gigantic. No, I'm not sick. I have allergies because I got Trashy back from my mom. My mom liked Trashy. Trashy's a very gentle cat. Trashy shows up a bit. Yeah, Trashy's more allergenic than the other cat. Yeah, I always had problems with Trashy and allergies.